Did it record?
Mm-hmm.
It's recording right now?
Mm-hmm.
It's got the little red dot?
Yeah.
And it's counting up?
Yeah.
Okay, great. Hey everyone, Paul Clark here, and in this video I want to talk to you about a simplified example of valuing a stock. And I really want to get into this because I think that a lot of people have a tendency, if a stock's doing really well, to want to buy it just because you think that the price is going to go up. And I really want to challenge you to think about not just the price going up, but what's driving that and what the actual true value of the stock would be. So I can even start out by asking you a question. If you were thinking about a car company and you found out that they were going to quadruple their sales, quadruple the number of cars they're going to move off their production line next year, would you expect that to be good for the stock or bad for the stock? Okay, and I feel like a lot of people intuitively would say that's going to be great. That's great news. I need to invest on that news. Surely the stock is going to go up. You're going to increase your sales by 4 times. How could that not be good? Well, it could not be good if the stock is actually priced like it's supposed to be earning 8 times sales or 20 times sales, and things like that, and those growth rates. And you might say, well, that's kind of ridiculous, and what stock would actually be priced with that kind of lofty growth priced into it? And again, when you look at companies like Tesla, or even to some extent Apple, some of those companies do have some expectations baked into the stock price that have really aggressive sales plans. So I feel like I want to be able to walk through an example where we can really kind of dumb it down. And, certainly in terms of the real world, you got to consider things like, there's multiple years that, companies can actually be producing profit and cash flow. You also have to consider with multiple years, you have to discount those cash flows back. Now, we're not going to talk about that in this video. What I want to do is just assume that a company is only going to have the ability to give you profit per share for 1 year. And what I want to do is, again, assume no discount for or discount cash flows. I don't want to worry about that. I just want to say, let's look at a company, just a general example, for 2021, and let's really look at what the price is per share, okay, and what their profitability is and what that implies the stock is actually worth. Now, if you were able to truly get all of their profit distributed to you from 2021 per share, okay, then you can start to figure out some of those things. You can start to say, okay, well, if we expect their sales to increase by 4 times from their 2020 earnings, you can start to say, okay, if this is how much we're expecting to sell, this is the price, this is the cost, you can start to work that back and say, what is the profit per share? You then can compare to what it's actually trading at and say, is that higher or lower? Okay, so, and then of course, what you really want to find out, you want to find those opportunities where maybe, your own expertise or your own insight will allow you to buy a company that's trading at a price that's actually lower than what you think it should be trading at, but based on the fundamentals. So that being said, let's go ahead and get into an example. All right, let's get into the example. Now, I will say next door, super great timing. There are some roofers working. Great that they want to improve their house. Less great that they wanted to do it right in the window when I wanted to record this example. With that being said, I'm going to carry on, and hopefully I'm loud enough to kind of drown that out. But if not, that's what you're hearing. But okay, let's get into the example. So in the example here, I've got 2 different scenarios. I've got the first one that's showing what the current share price is in our made-up example. And the second one, I'm going to kind of allow us to change some assumptions and see how that impacts the price per share, kind of a thing. And when I say the price per share, in this case, I kind of mentioned this in the intro video, but what we're going to be assuming is that we're only allowed to participate or to earn the 2021 earnings from this company. So nothing for 2020, nothing beyond 2021. You don't get any kind of, any of the assets or the debt, none of that. We're going to just assume that those things net to zero. They're going to be in business for 2021. You get that profit as an investor, and that's all you get. And we're also going to assume, just to simplify things, because I really want to get the concept here, just to simplify it, we're not going to be worrying about the time value of money. Now, you might not even understand that is a concern. That's something I can cover in a future video. Certainly in the real world, that is something you really have to factor in, especially when you're going to be looking at multiple streams of income over the course of many years. You need to be able to discount that back. But again, not the focus for this example. What I want to focus on is what the value of the stock is and how that relates to just some simple drivers in terms of how many units a company is producing, or at least for a company that's actually producing something, and what the price is, what the projected cost is. And I think I had mentioned before that what if you expected a company to increase their sales units by 4 times? And the question was, do you think that's going to be good for the stock, bad for the stock, neutral? And I think that intuitively, a lot of us, I think, would want to answer that that has to be good for the stock. But in actuality, you have to kind of compare that and kind of work backwards to figure out, what the stock is currently assuming the company is going to grow at. Because the current share price is really, it's a forward-looking mechanism that tries to understand how much cash or profitability that the company is going to be able to generate for investors. So baked into that is, the growth that's implied in the company. So again, let's go ahead and look at this example. So I mentioned the 4 times sales. Right now, if we were going to look at this, we're going to say that, again, made up numbers, but we're going to say that 2020 actuals, this company was able to put out 200 units and that they're projected to grow by 5 times. Huge growth rate here, 400%. Expected in 2021 to actually generate 1,000 units or sell 1,000 units. Let's say also, because we're going to assume that this is a car company, because I know that there is a particularly popular car company that has really aggressive growth targets. Speaking of course of Tesla, and I think that I want to kind of help put that valuation in perspective with this example. So if they're expected to grow to 1,000 units, so they're growing that by 5 times. The price for this per car we're going to say is 40,000, and we're going to say the projected cost is going to be 30,000, and this is between. We're just going to assume the projected cost has labor rolled into this, the cost of materials, anything else, marketing, whatever. So we're just going to say per car, there's $30,000 of cost incurred, $40,000 sales price. So there's going to be per car, every single time that they sell a car, you're going to be looking at getting $10,000 for that unit. Okay. And then I'm going to assume that in 2021 that there's actually 1 million shares outstanding. And what that's going to allow us to do, of course, is you need that share number to be able to actually divide their profitability back to understand on a per share basis how much you should be paying for that. So again, just this simplified example, just saying all you get to do as an investor is actually get their 2021 profit. You get all of it. They're going to say, hey, at the end of 2021, closing up shop, profit's yours. We're going to move into SpaceX, whatever else. They're done. That's our simplified example. So that's why we can say with our valuation that they would get all of that profit. So, right now when we do all those things, we can come up here and we can say, okay, if we have these projections in terms of units for 2021, we have our projected price. Well, we can project out then that they're going to sell $40 million worth of cars. With those units and that cost, they're going to have $30 million of cost. And in total, they're going to have $10 million of profit. Now, on a per share basis, knowing that there's 1 million shares outstanding, you would just take that 10 million and simply divide it by your shares and say, okay, on a per share basis, this is worth $10. Now, let's carry this through. In our hypothetical example, again, when we hear somebody say, well, what if a company could actually increase their sales units by 4 times? Well, if we're going to take 4 times 200, okay, we simply have 800. So then we can see how that math flows through. Well, if they were able to actually, increase sales by 4 times, a big accomplishment, certainly for any company. They're able to keep the projected price the same, the projected cost. The only thing that we're changing is units. What you would find is that they would actually only be worth $8 a share. Okay, so if they're truly worth $8 a share, if they increase their sales by 4 times, and then you go up into the current market, you go to your little Robinhood account, you go to your Fidelity, your Charles Schwab, whatever broker you use, and you find out they're actually trading at $10. Well, at that point, is that a good deal? Is that something you want to invest in? And the answer would, of course, be no. Okay, But we can also think about this in the reverse. If the stock is currently trading at $10 a share, and let's say that, based on kind of the simplified model that we have together here, if we think that they're not going to have 1,000 units in 2021, let's say that, they're going to reach, full scale, we're really bullish. Let's say that, you have really done some due diligence and you think that they're going to sell 1,500 units, okay? Well, then all of a sudden, just that one simple change alone can say that they would actually be worth $15 per share, because they're going to make in profit $15 million based on your projections, and then $15 per share is what you would be able to get, kind of a thing. So certainly, if you're able to look at the stock at that point and say it's available for 10, you believe it's worth 15, it'd be a no-brainer to say, hey, I want to buy that thing. But I think what the danger in some of these things is that, again, the danger is that you have a situation where maybe somebody's going to double their sales, which is great. Again, if you go from 2020 to 2021, and you can see just by doubling their sales here, that would mean that their stock price is really worth 4. But if they're priced like they're going to, increase by 5 times, then it would be a really bad deal to buy this at $10 if they're really on pace to be worth $4. So, and certainly the only variables, or you can change more variables than just the units. I just wanted to focus on that for a second. But you certainly could say, well, what if you just really believe that they truly are going to increase their sales units by 5 times, and let's just say it's a given, and so it's $10 a share for that profitability you're going to get. But let's say that you think that their cost is just going to be under more control than what they're currently projecting. Okay, so let's say that you think the cost is really going to be $25,000 per car, all in, marketing, everything else. Let's just say, making it up, let's just say that, you think, hey, Elon Musk is going to be, really ingenious with his marketing budget, and he's going to, rely on, organic social media that he's not paying for. And because of that, that's going to decrease, their selling and administrative costs, and it's going to, allow that the cost attributed per car to go down. Well, again, what we can see over here is that, similar to the units, just our change in our cost projection is going to change the profitability per share. So then all of a sudden, if you believe that to be true about the market, you would be in a position where you can say, hey, I think this stock is truly worth $15. I can buy it for 10. And of course, if that's the situation out there, you would want to buy it for that price. So I really, in this example, I really just wanted to highlight how, just hearing blanket statements about, subscribers have grown by, hear about Netflix and their subscriber growth. You can hear, they've grown their subscribers by 20%. Does that mean that you should buy their stock? And, when you work back, you can, in a very similar way to this, you can say, okay, well, how many subscribers, with that, even with a 20% increase, what would we expect their sales to be? What does that work back to in terms of profitability? And you can kind of figure out from that way, to what extent they might be, fairly valued over, undervalued, things like that. And certainly, when you're not using these simplified examples, things get a lot messier in terms of, there can be accounting changes that kind of muddy the waters a little bit. There's projections that are updating all the time. A lot of companies, of course, have multiple product lines, so it's not as simple as just saying, hey, there's just this one type of car. So all that being said, Warren Buffett always had a really good principle in mind, and he said that he wanted to have really a pretty wide margin of error baked into this. So in other words, if you thought that the cost was going to go to 29,000, okay, and you thought the stock was actually worth 11, and it's currently trading at 10. Now his thought would say, hey, you know what? Like, my margin of error could be within $1. So it's like, in all likelihood, this really could be worth 10, and I might be wrong by $1. So I'm not sure if this is a slam dunk investment. But now let's say that we increase the projected units to 2,000. Well, then all of a sudden, if we're in a situation where we think that it's worth $22 and it's currently trading at 10, Well, now let's even say that we're wrong by $10, which is, pretty aggressively wrong in that case, okay? Then you would still actually be looking at $12 versus 10, which would be a 20% upside, which would still be a good return. So I feel like, when you're kind of, going through this analysis, you really want to be able to have the widest gap between what you think the value is and what the actual market is trading at. Okay, so that was my example about, kind of walking through some simple valuation, and really, again, the point being that really kind of being critical and thinking about some things in terms of just not taking it at face value that, hearing things that a company is increasing subscribers, increasing units by a big amount, just not taking that at face value that that's going to be a driver for the stock. And in fact, there's a lot of times I think new investors can be a little bit confused if you do see a situation where, again, that if a company goes from 200 units to 800 and the stock drops, you're thinking you increased units by 4 times. What's wrong? Well, again, what's wrong is the market was expecting 5 times. You only got 4 times, right? So it's all about, what the market expects versus what actually happens. So with that in mind, hope you guys enjoyed this video. Any questions, go ahead and let me know in the comments below, but see you next video.